Kam, thank you very much for joining us to discuss this very hot topic of the benchmark transition from IBOR to ZARONIA in South Africa right now. We're very grateful to have the LMA support during this mammoth project. And what we've done as the legal workstream in order to support the market to start thinking about the transition was to publish a replacement of screen rate clause that was not an LMA standard, but that did recommend some wording that practitioners could start to think about on a bilateral loan basis. Since then, the LMA supported us with publishing an LMA-endorsed replacement of screen rate clause, and more recently published a rate switch agreement that hardwires the transition language. Can you take us through the high-level differences between the replacement of screen rate clause and the rate switch agreement?
Thank you so much for having me, Mosidi. It's a pleasure to be here and talk about this important topic. So really, with the documents that we've produced, essentially we now have a spectrum of approaches which parties can take. So the document that we produced last year, which was the revised replacement of screen rate language, it was really designed to help parties try to set up their agreements in order to make the change from JIBAR to ZARONIA, but at a point where we didn't know what the market was going to be moving to, we didn't have the conventions, and so really the focus of that was to try and make the process of amendment easier. So without that wording, we would have had a situation where these documents required unanimous lender consent, which obviously isn't very helpful, and so what the replacement of screen rate language did was reduce that to a majority lender consent level. Of course, now we have the MPG conventions that were published earlier this year, and that allowed us to produce the rate switch agreement, which we published in May, and that's really designed to provide a lot of certainty around transition, because it builds in all of the provisions that you need to move from JIBAR to ZARONIA, and also puts in an automatic switch mechanism. So it provides a hardwired fallback or a pre-agreed conversion mechanism, which is helpful because it means that that loan then doesn't become part of the legacy stock. You don't then have to revisit that agreement and sort of have an agreement at a later point in time. We are aware that there are a sort of spectrum of approaches that parties can take. So parties may not be ready to enter into the sort of full rate switch mechanism, but within the replacement of screen rate language that we published last year, there are also a spectrum of approaches that people can take in order to provide a bit more certainty. So, for example, inserting a pre-agreed date by which they're going to renegotiate and a date by which they can agree, or also have a term sheet of some of the agreed provisions, just to provide a bit more certainty as we progress towards the transition.
Thank you for that, Kam. And I like the fact that you mentioned that the rate switch agreement gives a greater level of certainty and, more importantly, reduces the legacy issue at the end, because that is very much our goal as the legal work stream, to ensure that we have as little of an overhang of legacy, tough legacy contracts at the end of the transition rather than more. But in relation to the conventions that you mentioned that the MPG has published ZARONIA-linked conventions. They are actually on the MPG page, and viewers can access the link from this page. Can you give us an overview or high-level summary of these conventions and how I can find references to them in the document if I'm working through the document for the first time?
Yeah, sure. So taking a step back, the conventions were designed to set out recommendations for the basis on which new loans should reference the overnight ZARONIA rate. And given that ZARONIA is a daily overnight rate, the conventions help to make that rate work for loans which require interest rates for longer periods, like 1, 3, 6 month interest periods. And at a high level, what viewers need to know is that the daily ZARONIA rate is effectively compounded in arrears, so over a period of time in line with the interest period. And because of that, it means that the final interest rate isn't known until towards the end of the interest period. So in order to provide some visibility, the conventions provide for what's called a look-back period, and a look-back period of 5 days is applied. So what that means is that you effectively have an observation period where you start calculating the ZARONIA rate 5 days before the start of the interest period, and then you end it 5 days before the end of the interest period, and that gives you a period over which the rate is calculated, but at least you have 5 days worth of certainty of what that rate is. And there are various other conventions around the calculation, which I won't go into, but I would just highlight that there are some very, very helpful publications from the MPG, which are on the SARB website, including a practical guide as well as a spreadsheet. And in terms of how those conventions are then reflected in the LMA document, most of the operative provisions are now contained in schedules towards the back of the agreement. And we have produced a commentary which contains an annotated version of those conventions as well. So I would really recommend people take a look at that commentary, because it sort of sets out line by line exactly where in the document those conventions are reflected.
And since the rate switch agreement is intended for syndicated loans, if I'm a mid-sized corporate and I, for the most part, enter into bilateral agreements, can I, as a legal practitioner within that mid-sized corporate, make use or reference some of the provisions in the agreement?
Yes, they can be. They can definitely be used for bilateral agreements. So although the LMA documents are very much set up in a syndicated context, the rate switch architecture can be put into bilateral facilities. And indeed, we did see this with LIBOR transition, where very much people adopted that architecture and applied it to bilateral facilities. And on our website, we do have a comparison of our original IBOR document against the ZARONIA document, and that actually is very helpful because it shows you what are the sort of changes that you need to put in the document, so parties can look at that markup and apply the same provisions into a bilateral document.
And now, for the elephant in the room, the credit adjustment spread. So we know that this is a very contentious topic in South Africa right now. And the MPG has created a new work stream to address this very issue and to create a methodology and to decide the credit adjustment spread. For those that may not know, credit adjustment spread compensates lenders for the differences in calculation between IBOR and the replacement rate. This is particularly important in the loans market because of the transition from a backward-looking rate on the one hand to an overnight rate on the other. In your experience, is it possible to start to renegotiate agreements when the CAS hasn't yet been settled? And if so, what practical steps?
Very grateful to have the LMA support us on this mammoth project.
Mammoth task without the rate being settled yet.
So I don't think people need to renegotiate the agreement, because what parties can do now is really future-proof, because we know that the MPG is going to recommend a methodology for the credit adjustment spread. So what parties can do is, within the definition of the credit adjustment spread, they can refer to the methodology that is going to be recommended by the MPG and sort of specify the rate that is set at the point of announcement. And so you can frame it in general terms so that it will kick in when that methodology is finalised and when a cessation announcement is made. And so I don't think parties need to wait until the point that the methodology is set or a cessation announcement is made. So parties can very much do that. And the approach that we've taken in our documentation is the credit adjustment spread definition is left blank. But the reason that we've done that is because we did see the approach to the credit adjustment spread and how it's defined evolve over time in agreements. So there are different approaches that people can take. So as I said, now that we're in this period where the methodology hasn't been set, people can at least refer to the methodology that will be recommended and as at the date at which it is set. But what we found that when the methodology was set and when a cessation announcement was made, parties like to have the certainty of referring to the actual specific figures. And so you often found people inserting tables within their agreement of 1 month the credit adjustment spread is X and 3 months it's Y. So you can do that. And also we saw that when people were actively transitioning loans, they may choose to use another figure or another methodology. But all of this explained is explained in the commentary. And like I said, people don't need to wait or renegotiate. There are ways to deal with this now.
I couldn't agree more. I think waiting is not recommended, and the sooner one gets started with considering these agreements and renegotiating where possible, that would be advised. So in terms of the timelines, what timelines are we looking at for the finalization of the exposure draft? What are the next steps in relation to that?
So the exposure draft is currently open for market feedback. So I would really, really encourage viewers to let us know their feedback on the document, because it's only really with that feedback on the document, its use in practice, that we can then finalise it. What I would say is that we don't have a specific timeline in place. So I know I've heard some people ask, you're not going to finalise it for another year. That's not correct, because actually if we get the feedback, if the document's being used, then we can finalise it very, very quickly. We can move it to recommended form. There's no issue with having a sort of a set amount that it needs to be in the market. We just need that feedback from practitioners. So I would really encourage people to get in touch with us. What I would also say is that we don't expect there to be major changes to the exposure draft, because it's very much based on what happened during LIBOR transition. And so it's really tried and tested methodology. So we're not expecting major changes, but as I say, we just want to make sure that once that document's been used in practice a few times, people to let us know, and then we can move it very quickly to recommended form.
The MPG has published a draft transition plan. It will be linked with this interview, and what it anticipates, or what it plans for,
to start towards the legal transition. The MPG's legal workstream previously drafted a very generic
and as of mid next year for ZARONIA to be used first in loan market transactions. What is the LMA? What are the LMA's plans to assist with this initiative? Can we expect to see an agreement that is specifically catered for new ZARONIA transactions in the pipeline?
So completely agree that one of the key aspects of transition will be, what does a new ZARONIA loan look like? Because it's not just about including fallbacks to ZARONIA, but actually using ZARONIA from day one, because it does raise slightly different issues, and parties need to know what that new world looks like before they can then transition their legacy book. And we fully intend on producing a day one ZARONIA facility agreement. I think before that, it would be great to close off the rate switch agreement, just so that we can be sure that we have clarity on the ZARONIA provisions to then move forward. But we are very much intending to produce an agreement to help parties prepare for that ZARONIA first initiative.
So I think within the context of loan markets, the terms term rate or synthetic rates get thrown about quite frequently, and some may consider them as jargon and may not necessarily understand what those terms mean. Can you explain what the difference is between a term rate and a synthetic rate means, and what this means in the context of LMA agreements, or your experience on LMA agreements?
Term rates in the context of the loan markets really emerge as a potential alternative to a compounded rate. So trying to create a forward-looking term rate based on the RFR rate. But in order to do that, what you would need to do is look to the derivatives market and either use futures or overnight index swaps to create some kind of term structure. And some jurisdictions did manage to create these term RFR rates because they had enough liquidity in the derivatives market in order to support those rates, whereas others did not. So it wasn't a sort of a one-size-fits-all solution, because it really depended on having that liquidity in the derivatives market present. Where they were created, they were, however, subject to limited use cases, so it wasn't that they could just be used necessarily for all loans, and maybe they were limited to certain types of transactions, so that's something that was limited. And they can be helpful, but they're not a magic bullet. They don't sort of solve everything. I think they've been seen by regulators as generally being less robust than using a compounded rate, because the compounded rate is based directly on the overnight rate, whereas, as I mentioned, the term rate is a function of the derivatives market, so it's not directly based. And also there are points that parties would need to consider around hedging, because hedging a term RFR rate is expensive because the derivatives market has moved to compounding. So it is more costly and it doesn't give you a perfect hedge that is a basis. The synthetic rates, on the other hand, are all to do with legacy transition. And these were really used by the FCA to help with LIBOR transition and particularly tough legacy contracts which weren't able to be transitioned in time. But they were very much a temporary measure. So there was an end date to the synthetic rates, so they aren't available, continuously. So there is an end date that's in place. But also what the synthetic rate actually means is it's just having a figure that's published on the LIBOR page. But what it actually is a term RFR rate plus the credit adjustment spread. So I think that's probably where the confusion comes in, because the term rate's used as the basis for the synthetic rate, but it was basically there to mean that contracts didn't then sort of go into the fallbacks and you still had a LIBOR rate being published, so it gave people time. But as I said, it's not a silver bullet, and it was very much used in just isolated context. So there were sort of other currencies, for example, the Swiss franc or Canadian dollars, where they didn't have the benefit of the synthetic rates. So again, it's not a solution that was applied consistently.
And I think it's important to add there that up until this point, the SARB's view on that is that we are publishing a compounded ZARONIA rate, and there's no plans, there's not necessarily any plans at the moment to publish a term rate as well, for the reasons that you explained, that it is dependent on the derivative market and it doesn't exactly mirror the performance of the compounded rate. And in relation to synthetic rates, which you mentioned address tough legacy contracts in particular, the view that we've taken up to so far is that we will deal with tough legacy contracts as a whole. We don't have any specific plans to publish a synthetic rate at this moment, and I think the market should use that basis to continue with the transition, that there may not be a term rate or a synthetic rate to be published in the future. And then some of the questions that we've been getting in the legal work stream relates to defaulted and non-performing loans and how they can deal with that. In the context of LMA documents, how would you recommend still including a switch if the loan is non-performing or has defaulted, and what has your experiences been in that regard?
We don't have particular recommendations, and what I will say is I agree that defaulting and non-performing loans, they are difficult cases because clearly the parties are going to have bigger issues that they need to deal with, as opposed to the interest rate, like getting their money back and getting the borrower back up and running. But as parties are working through those documents, they can try and take the opportunity to insert in the rate switch language. But also I think there's a lesson to be learned up front about why it's important to include rate switch language, because you may be entering into deals today that may become non-performing later on down the line, and you don't really want to be having to try to insert provisions to transition the interest rate at a point where a loan is defaulting or non-performing. And so I think that's where the rate switch agreement comes in and why it's important to try and put it in where you are reopening documents.
Exactly. I love that message because it reiterates sooner rather than later, and start to include rate switch language as soon as you can, rather than to wait for a non-performing loan or default situation. I think lastly what I can add is if I'm a legal practitioner that's interested in learning more about either the replacement of screen rate clause, the rate switch agreement, or any other learning materials that you've referred to today, where can I possibly access them?
The rate switch agreement and commentary are available to LMA members, but what I would say is that parties who are non-members and you're working on transactions where you want to use the rate switch agreement, speak to your bank, speak to your legal advisors, because then you'll be able to work through the rate switch agreement with them and have access in that way. Also, we're doing our best to try and make as much material as possible available online. So, for example, last month we did a webinar which was made publicly available. So we do try to balance what is publicly available and what is not publicly available. And of course, I would very much point people to the very helpful MPG site and the MPG materials, which has Yeah, fantastic sort of overviews of what the conventions are, but also I know that you have practical guides on there and spreadsheets, so I would very much direct participants to look at both the MPG site and also look at our website as well.
Thank you, Kam, for taking us so well through this very difficult and challenging topic. I think with the short timelines that we're really chasing towards the end of the transition period, we'd like to encourage any legal practitioner or any professional reviewing, looking at this interview, to start with the transition rather than later. Please do make use of the learning materials that are referred to in this interview and start transitioning your contracts sooner rather than later. Thank you.